If you're looking for dividend income, must look for stocks with growing dividends. Today I have 7 to cover you that are listed in Singapore. There's going to be 1 bank, 4 REITs, and the other 2, if you're curious to find out, continue watching on. Hi guys, welcome back. Without further ado, let's start with the list. And number 7 on today's list is actually Sembcorp Industries. Let's start with the story of Sembcorp's share price, because this is an astounding share price performance, correct? It did almost a 4-bagger in little less than 3 years. Take note again, this was D-Day for Sembcorp because it had its demerger with Sam Marine, right now merged into Seatrium. Back at that point of time, I didn't quite think the prospects of Sembcorp will be that good, but Mr. Market always makes people humble. Sembcorp has ran on this multi-year bull run, and I think quite possibly it's the best performing STI stock. If you look in terms of its dividend track record, you will see that its latest dividends are an improvement from its previous years. I will be ranking the stocks listed for today from my least preferred to my most preferred, so there are definitely stocks which I think I know a bit more and I personally prefer a little bit better. With that, let's move on to number 6 on today's list, which is actually Mapletree Logistics Trust. Many people compare Mapletree Logistics Trust with Ascendas REIT. Both own some industrial properties, it's true, but Mapletree Logistics is very different in the sense that it owns a lot in Hong Kong and China. If you see the breakdown, Singapore constitutes only about 20%, but Hong Kong and China constitutes more than 40%, of which top customers include Cainiao and JD.com. Mapletree Logistics Trust announced its results very recently, and it's good to see that it's going to increase its DPU yet again to 2.271 cents per unit. This will bring its total dividend yield closer to 5% per annum. Let's move on to number 5 on today's list, which is the one bank that I'm going to mention, UOB Bank. UOB was the first to release its results, so I'm using this as a basis to project what's going to happen with OCBC and DBS. I do think good results will come up for them also, because if you scrutinize what UOB has presented, it has shown that Q2's net profit has jumped 35% to 1.5 billion as compared to a year ago. They've also mentioned with Fed raising rates yet again, it is likely that net interest income would continue to strengthen in the quarters ahead. I would take a slight caution though, because I see a slight decline from June as compared to March 2023. The numbers are strong, but I don't know whether this growth trend is still able to sustain moving forward. But nonetheless, we will see that UOB has actually stepped up its dividends for 2023 in particular. Total dividends declared for this year is $1.60, which equates to a dividend yield of more than 5.3% at current share price. If you're keen to trade on UOB, let me introduce to you today's sponsor, which is Moomoo Singapore. You'll see over here that within the platform, you can actually trade UOB at $0 commissions, and there are fantastic tools to use on the platform, which includes news as well as analysis. For new users, Moomoo right now has a National Day campaign that will give you $700 if you are a new sign up today. That will include a 5.8% guaranteed yield from its Moomoo Cash Plus, as well as 1 free Apple stock and 1 C-Limited stock if you make an initial deposit of $10,000 and perform 5 trades. I think this is a fantastic offer, and that's why I would like to encourage you to check this National Day campaign, which is termed Rediscover Singapore, as we'll be covering a lot of Singapore stocks on this channel, and especially for today's tutorial. So if you're keen, look for referral links below to sign up today. Let's move on to number 4 on today's list, which is Parkway Life REIT. Parkway Life REIT has been a stellar performer, despite all the headwinds in the REIT space. It's a very defensive stock simply because it's in the healthcare sector. Not only that, it's actually well known that Parkway Life REIT has an embedded escalating clause within its rental of hospital clinics. Occupancy is 100%, and it owns some of Singapore's top hospitals, which includes Gleneagles and Mount Elizabeth. What I would like to share with you are some newest updates. We would see that first half 2023 results are recently out, and they have yet raised their dividends per unit to 7.29 cents. At current share price, is close to 3.7% dividend yield. Personally, I'm still keeping this on my watch list and hoping for a better entry price, because the yield is still quite low as compared to guaranteed instruments such as T-bills and fixed deposits. But it's also worth to note that its track record of growing dividends has been very strong. The only concern I may have, that there seems to be a lot of loans coming at 2024 that may need refinancing. When I looked at its presentation, I saw that its all-in debt cost was very low at 1.19%, and that's because the Japanese loan environment is very suppressed right now. We don't know how environments will change, especially for Japan's yen, which is volatile. If you're a shareholder or an interested investor, I would like to also give a good mention that they do have a Japanese yen income hedge in place until first quarter 2027. So far, if you have learned something, help me smash the like button, because it will help us reach a bigger audience together. And as always, let me know in the comment sections below what are your personal favorites and whether you agree with some of the analysis presented to you so far. With that, let's move on to number 3 on today's list, which is a company that I'm very familiar. It's a company I've covered before that pays quarterly dividends, and this is none other than iFast Corporation. iFast Corporation owns FSM1 and iFast, which is the B2B arm that I place a lot of business with when I build private clients' portfolios. Recently, I was also with CEO Mr. Lim at a conference. It's good to see him and hear from his point of view some latest developments in the company. He has mentioned also there are teething losses, especially with the recent acquisition of a UK bank, and from my understanding, they will position this bank to serve underbanked markets overseas. That seems to be a low-hanging fruit because Singapore's banking scene is so competitive. Most recently, GXS has actually launched a 3.48% per annum banking deposit account, and that's taken the market by storm. And that's why I also agree with Mr. Lim that probably Singapore is not the first market to prioritize in terms of breaking through with their banking solutions. Take note again, iFast has ambitious projects in Hong Kong, which you can understand as a very simple pension system that could bring in AUM to the group itself. iFast's business model is a lot of recurring revenues. And what you can see in recent share price is that it has jumped 20% in the recent few weeks. If you're keen on iFast, this is a dividend track record. You would see that you'll be paying 1.1 cents for the quarter of August 2023, which is consistent as the last few years and above what you used to pay before the pandemic hit. Even though dividend yield is low for this company, iFast can be seen better as a growth stock. Let's move on to number 2 on today's list, which is none other than Escort Trust. I'm a big fan of Escort Trust, and it was heartening to see its recent results looking quite good. Let me share with you some insights. The first to take note is that it has grown its DPU for first half 2023 by another 19%, clocking in at 2.78 cents. If we analyze this is a 5.1% dividend yield. Of course, the hospitality sector is not like the healthcare sector because hospitality can get affected by pandemics as well as recessions, people travel less. But at this period, I do think that it's in a strong recovery phase, and let me share with you some numbers. This is an interesting finding because for second quarter 2023, revenue per hotel room unit actually showed massive growth. The interesting part for me to note was that UK, Australia, Japan and Singapore actually showed better performance than before pandemic. Japan in particular has shown a massive jump, and quite simply because Japanese yen is so cheap, a lot of people are traveling there. Everybody is waiting for that big wave coming out from China, and honestly, I think they may prefer Japan first over Singapore. I've yet to see big crowds in Singapore, but I can feel their growing presence already. That's why on this channel I'll be covering an update on Genting Singapore, and as always, if you're keen to listen for that analysis, smash the subscribe button, get notified when it is released. Let's also touch on Escort Trust's debt. We would see that in 2024 there are significant amounts that may need refinancing. This will likely bring up its interest costs and impact its interest coverage ratio, but right now there seems to be a good enough buffer to withstand a shock in my opinion. That's why I'm more focused on the tourism number, and so far it's still looking good. But it's only ranked number 2, correct? So who's the number 1 rank on today's list? Let me share with you, it's none other than Mapletree Industrial Trust. Another REIT I've held in my portfolio for quite a few years. I've actually held Mapletree Industrial Trust at its peak at $3.20, and right now it's 30% cheaper than at the point of time. Dividend yield is right now close to 5% at this price, but let me share with you why I still rate it highly, as well as why I may be looking to make more purchases into this particular REIT. The nice part first, this is actually the dividend chart registered per quarter for the last 10 years. If you scrutinize for the last few years, it's been kind of flattish, correct? Especially with certain headwinds in the tech sector and interest costs going up. For me, when I saw the last number coming in at 3.39 cents per unit, that gave me some relief because maybe this is finally the end of the downturn and a new leg upwards. Mapletree Industrial Trust has recently made big acquisitions in Japan. Let me share with you some numbers to keep into perspective. Recently, a few months ago, Mapletree Industrial Trust actually raised monies at $2.21. This helped them with the Japanese acquisition without taking on too much debt. That's why the aggregate leverage ratio is actually still quite healthy at 38.2%. They've mainly financed this Japanese purchase with long-term notes, but I did see a big jump in terms of bank loans for financial year 2024 to 2025. This is where I'm pointing at, and my guess is this is actually a revolving loan for the acquisition, because this is a 300 million increment from just 3 months ago. So it's likely that once the acquisition is completed, they will move this bank loan to a longer term debt, and the completion of this Japanese data center will likely be in third quarter 2023. When I read around, I realized that Japanese properties are still giving a positive yield over borrowing costs. That's why many big players are acquiring Japanese assets at this current moment. To see Mapletree Industrial Trust making moves, I feel excited. At least the REIT manager is looking not just in US and Singapore, but to any opportunity around the world. Hopefully my faith in them will pay off, and as always, if you're keen to hear a bit more on my total allocations towards Mapletree Industrial Trust, check out this previous tutorial I have on my 9 streams of income. Over there, I give a glimpse of my holdings in it. Even see this tutorial, check that out. And if you're keen to understand what's the difference between Mapletree Industrial Trust and Capital D REIT, check out this previous tutorial I've done before that explains the key differences between them. If that's all from this tutorial and see you there, take care as always, goodbye.